Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
We're about 1 week into the Q4 earnings season. A good time to check in with our research director, Shiraz Mian, to see how he thinks things are going up to this point. Kind of early to tell, but it's not early to say that by all measures, this earnings season's off to a strong start. But even though, investors outwardly seem optimistic about this Q4 earnings season, stock prices are at historic highs.
Yes.
And that's pretty much across the board.
Yes.
So do you think investors this time around are going to be demanding unusually stronger beats than before and guidance in order to keep those stock prices propped up?
I think that's a fair assessment. You're right, as is the market high. We saw that in the trend of estimate revisions for Q4. Since October, when the quarter got underway, estimates did not fall, as has been the trend over the last many years. So estimates were fair. We are off to a good start, though it's kind of weighted towards finance in this early going, and we all know about all these one-time charges they are taking. But yes, we're off to a good start, and you're totally correct that given how high everything is, they are looking for stronger beats, good guidance, and more clarity and visibility with respect to the coming quarters.
So let me take that one step further.
Sure.
That being the case, does that mean investors are going to be now more willing this time around than usual to punish companies who report just in-line earnings or maybe disappointing numbers?
Sure, absolutely. The reward you get for beating estimates is less than the punishment you get for missing estimates. And even more than meeting or beating estimates, it's the outlook. So stocks and management teams that provide a downbeat outlook for the current and coming quarters should be ready. That's been a trend for some time now, and I think there'll be an even more pronounced trend this earnings season for those stocks to get pummeled once they give a tentative outlook.
All right, let's dig into this a little bit more. What is the beat ratio at this point in the reporting?
Sure. So we have 44 companies that have reported results this morning, and the slide basically compares the proportion of companies beating earnings and revenue estimates. The green bars represent earnings. The orange one, is that orange or red?
We'll say orange.
Okay, so the orange one is revenue. 77.3% of the companies are beating EPS and revenue estimates. And as you could see in this slide, when we look at the same 44 companies of what they did in the previous quarter, what they have done over the 4-quarter average or the 12-quarter average, you will see they're beating estimates at a ratio that's above normal.
Okay. So what about the scorecard? What does that look like?
So here's the scorecard. As I mentioned, 44 index members have reported results. Earnings are up 11.4%. Revenues are up 7.5%. And as we mentioned already, 77.3% are beating EPS and revenue estimates. You would see that 1, 2, 3 or 4 sectors haven't reported any results yet. And for many sectors, we are in the low single digits in terms of the percentage of the companies that have reported. Finance is the only sector where we have a sizable, reasonable sample at this stage. In fact, if you look at the table towards the bottom third of it, we show finance, and 43% of the sector's market cap in the S&P 500 have reported results already. So pretty sizable sample for that.
So we know that's going to change going forward.
It will, but it gives us a good representative take on how the sector's earnings results are showing up. And here we are comparing the earnings and revenue growth rate for Q4 for these 44 companies with what we had seen from the same group in other recent quarters. And you would see 11.4% earnings growth. a shade below what we had seen from the same group in the previous quarter in Q3. The 4-quarter average is 15.3%. It's better than the 12-quarter average, but it's below the last 2 data points that we have here. The revenue side, though, is better. You would see that 7.5% is better than the last quarter, is better than the 4-quarter average, and is better than the 12-quarter average as well.
So what are you expecting to see as the standout sectors this time around?
So as I mentioned, finance is the only sector that has any sizable number of companies, and I'll show you a little bit in detail as to how finance sector results are coming out. But in terms of the standout, I think technology should do better. There's strong growth expected from the sector, and we have been seeing some strong performance in the market too, in terms of pre-announcements and general management commentary too. Let me take you to the finance sector, and as I mentioned, 43% of the sector's market cap has reported results already. You could see the left-hand side chart is comparing the earnings and revenue growth rate for the finance companies that have reported results. The right-hand side chart is showing the proportion of finance companies beating estimates. If you focus on the growth part of the chart, 2.8% earnings growth and 3.1% revenue growth. Earnings growth is significantly below what we had been seeing from these companies in other periods. And I do want to remind viewers that we exclude these big charges that these companies take. So the Q4 growth rate for the sector has not been brought down by the charges.
Right.
So the sector's growth is nothing to write home about, but that's about the only sizable sector whose results we have seen thus far. I do want to spotlight this one element that we have in the Q4 results at this stage, and this is the momentum on the revenue front.
Okay.
And this comparison chart shows the revenue growth rate on the left side and the revenue beat ratios on the right side. And you could see there is strong growth on the revenue side, 75%, which is better than 3Q. You would recall that we had very unusually strong growth in the Q3 earnings season as well. So we are tracking better than what we saw there. And a bigger proportion of companies are beating estimates as well, which otherwise in a typical quarter may not be a big deal, but it is a big deal this quarter because estimates for Q4 had really held up quite nicely in the run-up to this earnings season.
All right, you wrote in this morning's written earnings outlook commentary on Zacks.com that tax overhaul pushing estimates higher.
Yes.
This morning being January the 18th. So that's a good thing?
It is a very good thing. It has direct benefits for many of these companies whose tax rates is coming down 35% to 21%. That's a huge gap. If a company's tax rate was 35% and it is coming down to, all of that additional money is literally coming down to the bottom line. We have had most of the results thus far from the finance sector, and many of those guys are guiding us what their tax rates on a going forward basis are going to be. But in addition to this direct benefit, which should start showing up in estimates, and I have a slide that I want to show viewers as to how that direct impact is showing up. There is the indirect benefit from tax cuts, which through greater economic growth and greater momentum and excitement and impact on consumer and business confidence should show up in revenues and business opportunities and operating outlook. So just to give you one example, the tax cut includes this accelerated depreciation component. Now, that is expected to increase capital spending by technology companies, industrial companies. Their business increases. They have to borrow money from the banks to invest in those businesses, so banks benefit from that. So the tax cut is expected to have both direct and indirect earnings impact, which we should be seeing in the coming quarters. And this is the slide I was referring to. And what I'm showing here is what is expected for the current quarter, the 2018 Q1.
Okay.
At the end of November 2017, the expectation was that earnings growth in Q1 18 would be 9%. Mm-hmm. The typical pattern over the last many years is that the 9% growth rate would have been coming down. So by now, we should have been around 7%, 6.5%, perhaps even less than that. Mm-hmm. The opposite is happening here. Estimates are going up, and it's steadily going up. The 12.8% is the current rate, and my sense is that when all is said and done, we would be perhaps 13, 14% growth rate. So a very direct earnings impact that we were discussing earlier.
Yeah. So having said all of this, what are you looking at for the entire year 2018 as far as earnings strength is concerned?
So very strong earnings growth. Just to lay it out for you, earnings growth flattened out in 2015 and 16. Part of that was in the energy sector problems, but there were issues in other sectors as well. In 2017, we came out of the earnings recession and that flatline growth. We would end up around 7-8% earnings growth for full year 2017. It's ramping up into 2018 and 19. I mentioned the first quarter. This growth momentum is continuing into Q2 and the second half of the year. 14-15% earnings growth for full year 2018, and that continues into 2019 as well.
I have to ask you, are earnings going to peak when the market peaks?
Well, the market should peak if it's driven purely by earnings much later than what we are seeing now.
Okay.
The market is trying to anticipate corporate profitability.
Right.
But as we all know, there's way many variables at play on the market at any point in time, from interest rates to geopolitics, and all of those factors could push stocks lower, particularly when we are at such elevated levels as we are right now.
Okay. I know you'll be checking out with all of this stuff all through the reporting season.
Sure.
Keeping your eye on it. We'll be checking back with you. And don't forget, in between these video chats, all you need to do is go to Zacks.com if you want to be up to date on Shiraz's latest commentary. His earnings previews on Monday, and his earnings outlooks midweek, Thursday, Wednesday, something like that. With Shiraz, I'm Terry Ruffalo.